All right. No, there it is. All right. So now we got Mike, huh? All right. Good morning. How are you? Comment allez-vous? This is Trade Non-Farm Payrolls Live, month 194 in a row. Huh? So thank you to FXStreet for hosting us. This webinar alone, just this one webinar, has been a 16-year journey. That's longer than your last guru has even traded Forex. This webinar is more than 16 years in the making. So thank you to FXStreet for being such wonderful hosts and hosting me for all these years. And of course, this isn't the first webinar series that we started. I had been already working with FXStreet for a couple of years before we even started this. So that must mean I go back with FXStreet, almost 18 years. So that's really cool. So Trade Non-Farm Payrolls Live. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. So let me introduce myself. My name is Wayne McDonell. I'm a foreign exchange trader. I'm a macro trend trader, which means I like macroeconomics and fundamental analysis to put together a bias before I even look at a chart. In the beginning, I knew nothing about trading. I'd never really traded stocks or options or futures. I started with Forex. Before Forex, I was a venture capitalist. So trading the stock market sounded stupid. But I ran into this article where it told me Forex was $2 trillion per day. So I quit my VC job and became a full-time Forex trader because that was, to me, an unthinkable amount of money. Oh, you can hear me twice? Really? Does anyone else hear me twice? Oh, okay, now it's fixed. Okay. So anyways, $2 trillion was an unthinkable amount of money. I just couldn't believe. Chasing $100 million a year market sounded stupid. $100 million a year versus $2 trillion a day. So anyways, that's how I got here. But in the beginning, there was no technical analysis. I knew nothing about fundamentals. To give you an idea how long ago this is, this webinar series, for example, that I've been doing with FXStreet is older than YouTube. There was no YouTube. There were no gurus. There was no Amazon.com. At the time of the beginning of this webinar, there was an Amazon.com, but it was an online bookstore, and they didn't have anything on Forex. So I went to Barnes & Noble. They didn't have anything on Forex. So I went to the Stanford Library, right, at Stanford University. So I went to their library and to their bookstore because I thought, well, maybe Stanford teaches foreign exchange to their finance people and their econ people. And, I ended up buying some books by Ben Bernanke, but there wasn't anything specifically on Forex. So I taught myself. I had to teach myself moving averages, oscillators, pivot points, leading indicators, lagging indicators. And it was difficult. There wasn't a lot of information. Now, on top of that technical analysis from all the professional investors I knew, and I knew a team at that time that had $300 million, and they thought, Forex was stupid and full of scam artists and scumbags, and they were actually right about that. And then the second thing is they thought technical analysis was stupid. So that was as much guidance that I got. So later on, after I started to figure out how to trade a little better and profitably, then I thought, well, I should try to figure out why. And I got licensed and registered with the National Futures Association, which required the Series 3 examination. And I learned things about futures and options and hedging and speculation and in particular in the grain markets and the energy markets. There was a lot on grain and energy, right? And gold, I suppose. So precious metals, softs, energy. Okay. And so I started to learn about these commodities, and I realized, it dawned on me, it's why money was moving. When Japan buys oil, they're importing oil and exporting yen, which gets converted into, I don't know, Canadian dollars or something, right? And I'm like, oh my God, it's the reason. So it really sparked a new interest for me as a currency trader. Suddenly, I realized there was a reason why currencies were changing value. And so up until then, I only could use technical analysis, which told me what had happened already. And some of the indicators kind of helped figure out what might happen next. But I realized most of our indicators were backward looking. So I'm like, oh, the why I found very interesting. Why it's changing, which means if I could understand the market a little better, I might be able to predict some patterns before they occurred because I understood why. And I ran into other things because of that journey, that exploration. Remember, you should always be a student. I've been doing this for over 20 years. I consider myself a student as well as a teacher, a leader, a mentor. Okay, but I'm a servant leader. But I still consider myself a student, which I'm very eager to learn. And so as I explored that idea of why, suddenly I recognized through my fundamental research that there is some seasonality. Things tend to happen in patterns for a logical reason. Okay? Like, for example, when there's lots of demand for oil, there's a reason for it. And I can explore that. And so there are peaks and valleys typical in a season. And again, you're like, well, what is a season? Well, think about wherever in the world you live, there are farmers that produce food. And you could probably guess what time of year they are thinking about planting seeds. And of course, before that, they have to turn the soil. And before that, they probably have to maintain their equipment. So there's a process, right? You do maintenance on your equipment to get it ready for the season. Then you turn the soil, and then you do some planting and all that kind of stuff, right? And on what day? Well, you don't know what day, but what month? You probably know what month this process starts. And then depending on the year, you can, well, the week might vary, but the month probably doesn't. And same thing with the harvest, and then everything in between. And you don't know the weather this year, but you probably can guess what July is going to be like, right? Is July going to be hot this year or cold this year? You're like, well, I have to read the Farmer's Almanac. No, but what for you, is July generally cold and rainy or hot and dry or snowy? Okay? Well, you probably have a reasonable guess on what it's probably going to be like. And why is that? And you're like, well, every season, July tends to be such way because of the way the earth, tilts toward the sun and wobbles around its axis. And you're like, so the patterns can vary, but generally, a pretty good idea. And that's what I found in Forex. So once I kind of got that down, I went to Harvard and got a macroeconomics degree, even though, think about it, when I say I'm still a student, at that point I have 10 to 15 years of macroeconomic trading experience. And I decided to get a 4-year degree in macroeconomics starting at the very beginning. That's kind of hard, isn't it? To start at the beginning. You think you're an expert. You've been doing this for 15 years. You already know, right? Humble yourself. Walk in as if you know nothing. And that's what I did at Harvard. And so I bring all this here because I want to share. I love what I do. I don't know you, so I can't tell you that I love you. But I love what we do. I like being with you together, especially around non-farm payrolls, which is an extreme event. And again, I love working with FXstreet for these decades. So great. So that's me. I want to help. Let me know how I can help. Please ask questions. Also, probably half the people in the chat, if not 3/4 of the people in this chat, have known me for many years and even over a decade, and even going all the way back to the first non-farm payrolls. So if I miss your question because you ask a question and I give a 10-minute answer, there might be 15 new questions that come in. If I'm not able to capture what you're asking, someone else here probably can. Right, Adam? Again, I've known Adam, 10 years, maybe more, probably more. So Adam might be able to help. So ask your question. And as a community, we can work it out. Okay? Great. So you're probably wondering about non-farm payrolls. And there are trends and counter trends going on. Okay. Yeah, it is 15 years, isn't it? It's just amazing. $15 sounds like a lot. I would have guessed 10 or 12, but it's funny how time goes by, huh? Okay. Yeah. All right. Okay. Non-farm payrolls. Yeah. Since 2006? Really? Wow. No kidding. Yeah. Well, I need to come visit when it's not hot and dry. When it's not hot and dry in the desert. Yeah. Or actually, it might be hot and humid for you. Oh, man. I know Dubai gets hot and humid. It's crazy. Anyways. So we're wondering about number of jobs, right? In fact, let me just clear this up. Let's just clear this up. Yeah. Okay. I'll move this to pink, right? Number of jobs, right? That's what we're looking at. Now you can break this out to all the new jobs, but then how many people have been looking for jobs and didn't get jobs, and how many people had jobs and lost jobs. So we're looking at not just the employment rate or the unemployment rate and all of this, right? Why do we care? Remember, I'm very much interested in why. Who cares? Well, here's the situation as it is. There are 11 million jobs and 5 million people looking for jobs. So who cares about non-farm payrolls? Now, the change, okay, if 11 million drops to 9.5 million, then the question is, why are companies not looking for employees? Did they give up looking for employees? Or is the recession starting to kick in? Okay, so that's really the general question. But then once you answer that, why the change? Why does that matter? Why do we care about that? If you answer this, okay, why the change in jobs available? By the way, that's JOLTS you can look at. Okay. Anyway, so why the change? Why do we care about that? Well, there's two things going on here. Okay, it's 2022, then comes 2023, and then comes 2024. By the way, I hope you don't mind that I go fundamental here. Okay? I hope you don't mind. I know everything's in the price. I get it. But let's just have this intellectual conversation, in particular with me talking out loud to myself in my office. Okay. So we're raising rates here, right? And somewhere in here, we're going to stop raising rates. So interest rates up, interest rates flat. And then I think in 2024, interest rates down. Okay? Now, all of this stuff comes down to what we call a terminal rate. Okay? And a neutral rate. Neutral rate. Okay. So how does this work? Interest rates are going up because inflation is high. So we'll say I is up. Then it'll go so high that it'll start to slow the economy. Jobs will slow down. Unemployment rate will rise. But, right? And some of the demand will be destroyed because that's the only thing the Fed could do. Okay, so let's put some numbers on here. Let's say now this whole process started around 1%, whatever, and just go with me here. And then all the way to 4%. And then 2%. So this is what I'm saying. Inflation's high, but only partially because of demand. I would argue mostly from supply, and the Fed can't do anything about supply. But the world will recover. So let's say they start raising interest rates. We go to 1, 1.5, 2, 2.5, 3, right? And we keep raising interest rates. And let's say we get to 4%. And then we stop because those interest rates at that level are actually starting to hurt the economy. And that's the whole point of the Fed raising interest rates when inflation's too high. They have to kill demand, which means they have to overshoot. They have to raise interest rates too high to do a little bit of pain. But it's like, you're like, well, why do they do that? Well, does anybody here like getting a filling at the dentist? Where they get that drill out? Right? You're like, oh my God, that's the worst. No, it's not. How is it compared to a root canal? I had a root canal once, and they tried to give me like an emotional consultation. I'm like, dude, I'm not going to kill myself. Let's just knock this thing out, right? But how about a root canal versus getting your tooth pulled, yanked right out of your gums, splattering blood and spit and tears all over the walls, right? So sometimes you got to do some pain to avoid more pain, which avoids even further pain, right? So anyway, so you raise interest rates too high, and then you have to stop at some point because it is hurting the economy. That's the terminal rate, the peak of interest rates during this cycle. Then, right, also during this period, and then to this period, I am pricing in, or assuming, or modeling, that China comes back online, gets its factories up and running, clears out all the backlog of orders, gets the supply chain of boats and airplanes and trucks and all these things to move the products from China to the United States, let's say, of course, and to all over the world. And then when you get to those ports, the ports can handle the shipments and then take them off the boats and put them on trains or put them on trucks and move them to the Amazon.com warehouse, right? And that we get this whole thing back in order. Now, could it take 2 years? Yeah, probably could. But my point is, during this cycle, the central banking cycle, or this business cycle, that supply chain will come back online and eventually normalize. And that's important because when we get to the interest rate at being 4%, it'll slow the economy down on the demand side only, which allows the supply chain to catch up because now we're ordering less. And China is focused on fulfilling the orders already made. Okay? Which allows them to catch up. And by the time we get to the end of 2023, maybe early 2024, guess what? The United States goes into recession. Mostly because we've destroyed demand. And some people have lost jobs. And maybe the stock market at least does not go up. We might fart around in the stock market where it's basically flat for 2 years. Oh my goodness, right? Good morning, Maida. Okay. And Lucas and Sean. Right? So a recession kicks in. Demand slows down. China catches up the supply chain. And guess what the Fed does? Lowers interest rates. Ho, ho, ho! A little QE maybe? But anyways, lowers interest rates. And now the stock market goes up and housing prices go up. And interest rates go from 4 to 2, more likely even 1.5. Okay? Okay, goes from 4 to 2, maybe even 1.5. And then they leave it there because the Fed wants something between 2 to 2.5% inflation. We want growth, not inflation. Let's call that GDP. Okay. And so therefore, maybe interest rates go all the way down to 1.5%. And therefore, we're constantly got a little bit of inflation, a little bit above average growth, and everything is right as rain. What do you think? You're like, I don't know what you're talking about. Why are we talking about this? Well, I started, why do we care about non-farm payrolls? Well, if non-farm payrolls is really bad, I mean not a little bad, I mean really bad. So no jobs are being added, unemployment is going up, and you want to look at the trend of jolts, for example. Let's say jobs go from 11 million to 9.5 million to 8 million. And not only are we people losing jobs, companies stop looking for employees. Okay? So what would happen is you're like, we're going into recession now. Not the end, not the middle to end of 2023 when interest rates are 4%. When interest rates are 2%, we're going into recession. Okay. Well, what would change is the terminal rate would probably change to 3%. Because we don't need to raise interest rates to 4% because we're already slowing down. So it's the change in the terminal rate that we care about. We already know what the neutral rate is. Okay. Anyone that's visited it. Oh, by the way, I didn't even tell you about FX Bootcamp. But we can get to that. I was just saying at FX Bootcamp, there's a macroeconomics course. And so you know already the long run rate of GDP in the United States going back 50 years. So you already, for example, if you've done the macroeconomics course at FX Bootcamp, you already know what the neutral rate is. And you know the number that the Fed's probably thinking. Okay. J-Man says, Trader's Way is out of my reach. Yeah, but yeah, I mean, what can we do? That's the, those are the rules and regulations being respected. Okay, so it's not them saying you're bad. It's the rules and regulations, right? By the way, if you're not familiar with Trader's Way, I've been working with them now for pretty close to 10 years. And Trader's Way is really interesting. If you go back to the Swiss National Bank debacle of, I don't know what year it was, but FXCM went out of business in the United States. They lost hundreds and hundreds and hundreds of millions of dollars. And Alpari went out of business completely globally. These were very, very big brokers. And FXCM in the United States was likely the biggest broker in the world. And they went out of business when the Swiss National Bank surprised everybody by pulling its peg. Which, when I look at it, it makes me think they were trading against their clients. Because why else were they hurt? But the experience that I had with Trader's Way at the time is I contacted Trader's Way and I'm like, oh my God, brokers are going out of business. It's the end of the world. I thought it was another 2008 financial crisis, like banks were going to fail and everything. It was that bad, or just that dramatic. And I contacted Trader's Way and I'm like, how are you guys? Are you guys okay? Because they're not big giant brokers with millions of clients on their server, right? 100,000 people trading on one MT4 server like some of the other brokers. Anyway, so I contacted them. I'm like, oh my God, are you guys okay? And they're like, yeah, we're totally fine. But I'm like, brokers are going out of business. How are you guys doing? And they're like, well, we executed all the trades. We're not holding any client trades. All those trades are in the interbanking system. They're like, so we're fine. Now, our clients might be losing money because they made bad trades, but they're like, we executed the trade. So as a broker, we're not facing any sort of risk. People said sell, we sold. People said buy, we bought. It's in the interbanking system. We executed the trades. Everything's fine. And I'm like, oh my God, I love you. So anyways, Trader's Way. See if you like them, tradersway.com. One of the things that you will find, if you want to learn how to like compare apples to apples, there's ways to figure out execution speed between MT4 and MT5 brokers. Trader's Way is near the top of speed. So if you're looking for latency, you're like, okay, maybe it's not the fastest, but it's way above average. It's very fast. Okay. Compared to some big brokers, like I said, that got 100,000 clients on one little MT4 server, slow as molasses, right? Okay, great. Or maybe those other brokers are slow because they're slipping you, which means you might lose a half a pip in and a half a pip out, and you don't even know it. Okay? But the real apples to apples is you compare swaps. Okay? And you can do that this way, where you open this up. Okay? And you go like this, okay, you highlight a currency and you click highlight specification. And you can see if you're short USD Mexican peso, you earn money. That's the interest payment. So what you'll find in many, many, many brokers, they think retail traders have no clue what they're doing, which is probably right. And that, why pay you a swap? So if you think about it, if you're a broker and you got 10,000 people, you could collect that swap and just keep it, and none of the traders care. But if you got 10,000 people that should be paid swap, you keep that swap, and it's real money when on the aggregate level. You don't care if you don't get paid, 27 cents today on your mini lot, but 10,027 cents is per day is pretty good for a broker. But not only do some brokers not pay you, oops, I guess I can't draw anymore. Some brokers, not only do they not pay you this 25, they'll charge you. They'll charge you. They'll take your 25 and charge you negative 68 on both sides of the trade, whether you're long or short. They're double dipping you and pulling money out of your wallet at the same time. And it's common. And really, to be fair to the brokers, it's expensive to run a brokerage with rules and regulations and all that kind of stuff. So they're just, on your $300 account, how are they supposed to make any money and still provide customer service and pay licensing fees? So what they'll do is that most retail traders don't know, and so they'll just hit you with these. They'll take the money that you're owed and then charge you money on top of it. Traders Way pays you your swaps, and they're huge. They're some of the biggest swaps available in the market. From my research, they not only pay you, they pay you a lot. Okay? So that's how you compare apples to apples. So if you're interested in a trustworthy, ethical foreign exchange broker, go check out tradersway.com. Cool. So let's zip over. What do we want to do today? I guess I have to explain a high volatility event-driven strategy. But anyways, I'm trying to get you to why do we care about non-farm payrolls? We care about the terminal rate. And if the terminal rate adjusts from 4 to 3, it's not likely to go the other way, not from 4 to 5. But let's say we're already looking like we might have peaked. Okay? Then what will happen is people will realize they overpriced. I want you to think about this. Because some people they're like, what do you mean it's already priced in? Well, okay, institutional investors are already doing this type of analysis. I know retail traders probably are not, but institutional traders are. And they're saying, we priced in a terminal rate of 4%. But if NFP comes out horrible, it has to be horrible, guys, not just a miss, horrible. If it's horrible, they're going to say, oh my God, the Fed's not going to raise to 4. They're only going to raise to 3. What does that mean? There's too many rate hikes priced in. And we know the delta of high interest rates is likely to create strength. But suddenly, if too many have been priced in, they're like, oh my God, we're only going to 3. Then the dollar is overvalued because its valuation is based on these assumptions. Okay? So the dollar will get weak because it's overvalued. But what will happen to the stock market? Does anybody know? If we have a bad non-farm payrolls and the Fed's not going to raise interest rates to 4, but instead to 3, the present value is equal to the future value of cash flows over 1 plus I to the end period. So if we were talking about 3 years, this n would equal 1, okay, plus future value over 1 plus I to the 2, and the future value over 1 plus I to the n. Okay? Take out the variables now. The variables, future value, okay, of 20. So the value now, 2023, $2024. Okay, what did we say here? Oops. Guess I have to put this back. There you go. We said inflation this year would be, what did we say? 0.01. Okay, and now if it's changed from 4 to 3, now you got to change this to 0.03. And then this goes all the way back to 0.015, right? And so the question is, if we've changed this from zero, so if we did these numbers and said 0.4, but now changed that to 0.3, and you compared the two, what happens to the value of the stock market now? The present value of what? Let's say S&P 500. So if we change the variable from 4 to 3, meaning NFP is bad, the terminal rate is not 4, the terminal rate is 3, you bust out your cash flows, and you, for the valuation of the S&P 500, and what you'll find is the stock market rallies today. Why? Because the terminal rate has been wound down compared to what is already priced in. Oh my God! Huh? Any thoughts or questions, concerns, comments about why NFP matters today? We discussed current interest rates, future interest rates leading to a terminal rate, to timing of a recession and the importance of that, tying that into the neutral rate. Okay? And that this is a flat year, or a down year, flat year. I think probably still flat here. And then up here for asset prices. Thank you, Santiago. Well, I just tied that up. So Kesh says, can you okay, so let's take this further. I answered it earlier, but let's review it, right? Again, I love it. Kesh says, well, why? Does it matter? So I answered all this, but let's go back here. If the value, if the terminal rate is lower, but the current price of the dollar is priced based on the assumption of 0.4 for the terminal rate, 4%, versus 3, then the USD, so if it was 4 and now it's 3, then the USD is overvalued. Okay? And if you do, right? And you're like, what do you mean it's overvalued? So if you actually did this formula, okay? Well, stock market up, US dollar down. You have to understand that. Okay? But nonetheless, if you did this, the future value of Apple, or the present value of Apple, what is Apple worth today? You would want to look out, let's say 3 years. You might do this model out 5 years, but the farther out you go, the more you're guessing. But you'll say, okay, what are their cash flows? What are their revenues or profits? You can measure whatever you want. Okay? For this year, next year, and 2024. How much money? This is what we're talking about. How much money will Apple make in these years? And what will be the inflation rate be this year? N equals 1. Next year, based on interest rates, for example. And then 2024 interest rates. And you start adjusting. So let's say you do a base case, worst case, best case scenario. And you start playing with these numbers. So by the way, this is what you do in finance. This is finance. And you do this in Excel. So what you do is your base case is this. Your best case is interest rates stay low and money stays cheap for longer. So maybe a faster recovery. And then your worst case is a horrible recovery where China just keeps going back into COVID lockdowns and we never get the supply chain up and running and all this kind of stuff. And you start pricing that where the Fed will have to raise interest rates to 4 and leave it there maybe for longer before they can cut interest rates, right? Like stagflation, for example, high inflation and in a bad economy because the supply chain hasn't been fixed. So you do best case, base case, worst case, compare them by changing these numbers. And what you'll find is this change from 0.4 to 0.3 means the US dollar is overvalued. The present value will fall, right? The new present value will fall relative to your old present value. And you're like, oh my God, the US dollar is overvalued. It's just math. It's mostly why the stock market came down. Once again, I'll tell you, the middle of last year, June, July, August, September, I predicted the U.S. stock market would fall by 10 to 20% starting in January. Not December, January. Now you're like, well, it started in November. Well, I can't predict that. I didn't know Omicron, right? But I did predict 10 to 20% in January. And you're like, well, why? Well, the Fed was going to raise interest rates. They told us. We just didn't know when. And so I looked at some seasonality and I looked at when I expected the Fed to start raising interest rates. But here's what you do. You change the math. So I updated the math, which is this number. If this is going up, okay, then the USD at that point is undervalued. It's just math. Cool. So what do we care? Because it shows things like risk on and risk off. It's just math, y'all. Could Struck says risk on equals BTC up? Yeah, I would say that would be true. All right. Dollar currently neutral. Let's put some colors on this. Okay, dollar neutral, yen weak, Swissy neutral, CAD strong, Euro strong, Aussie strong, pound weak, Kiwi strong. Cool. So if we're going to look at this simply as relative strength today, you'd want to pair strong versus weak. So Aussie yen, Euro yen, CAD yen, don't trade pound. Okay. Now, this is what's happening now, but it doesn't really tell you what's going to happen with non-farm payrolls. So again, when the numbers come out, you have to think good, bad, or the ugly, and how does this impact the terminal rate? The other thing you want to look at to create a fundamental bias is things like GDP. GDP is equal to C plus I plus G plus X minus M. All right. So what you look at all this in dollar terms because the dollar is a unit of account. It's hard to compare bushels with boxes, okay? So you boil everything down that you produce in dollar terms. So you're kind of looking at, GNI is looking at receipts, and this is kind of the opposite of that, but, you know, this is consumption, this is investment, this is government spending, but then we produce stuff in the United States and then sell it to foreigners. We don't sell it to consumers. We don't sell it to businesses. We don't sell it to the government. We sell it to foreigners. So we care about that, but we have to then subtract the stuff we import because we might have spent money on a Toyota made in Japan, but it's not our productivity, it's Japan's productivity. So when we're looking at our productivity, how much did we produce? Okay? We want to extract our expenses. These are expenses. Okay? We don't want that, so we subtract expenses. What are exports? Income. Why? You're a farmer, you grew some wheat, and you sold it to a foreigner, and to compensate you for your time and expenses, they paid you money. So money in, income, product out, export. Okay, when we import, what do we say? Well, we can make a car ourselves, but we'd rather have Japan make it. So we give them our money, export money, and we import a car. Or we export money, import a TV. We export money, import a phone. Some things are it's just better. But these are expenses because money is leaving our country. Whatever country you're analyzing, imports is money leaving the country, and exports, you get compensated with income for the product and service that you offered to a foreigner. So this is sales to foreigners, okay? And this is purchases from foreigners, and purchases are expenses. So we might, right? So if with the United States, I'm sure you're analyzing these details, but commodity prices are up. So in terms of dollar, X is much higher than normal, okay, versus normal. Okay? And here's the other problem. M is lower versus normal. Is it because Americans are broke? No, because foreigners are not making stuff to sell us. There's nothing to buy right now with your money, so you're not spending the money on foreign products. You might be spending it here, you might be consuming here. Okay, you might be going to the beach and spending your money at Marriott and at the swim up pool bar. But you're not importing stuff from foreigners because China shut the factories down. So what happens is imports are lower than normal, exports are higher than normal because of commodity prices. So now we have more income than normal, less expenses than normal, less money leaving the country, more money coming into the country, which means if that continues, the dollar should go up. If it continues. So you have to analyze that. Okay. Construct says PMI data is leading. Yeah. And so if you analyze the manufacturing PMI export and import subcomponents, which I have, you will see X minus M is equal to USD up. But that's backward looking. So that basically said that's been happening. Okay, great. The question is, do you think it'll continue to happen? And as long as commodity prices are high and foreigners are buying American commodities and supply chain remains tight, which means there's nothing to buy internationally, or at least less than normal, then the dollar should go up again. Also, if you think the terminal rate, let's say that you think the terminal rate is being priced in at 3.5, and then they say, NFP comes in red hot, people are getting jobs, wages are going up. You're like, okay, you're going to raise your terminal rate from 3.5 to 4. And what does that mean? The dollar's undervalued. Why? The present value of the dollar is equal to the future cash flow over 1 plus, I to the n. I is going up. Okay. Now, I know it seems backwards, right? But the idea is the higher rate hasn't been priced in. The stock market comes down, inflation and interest rates go higher, and that has sort of a carry effect of suddenly the dollar needs to get stronger because foreigners are going to try to lock in that higher interest rate. But it also means the stock market's likely to come down and maybe a recession is earlier. Okay, so ultimately, most likely, non-farm payrolls is not that important, but I want you to think about what you think is going to happen. So like if I pick on euro dollar here, and I got to get ready because this is going to come out quickly or soon, euro dollar. Okay. If you thought the dollar will continue to be strong, non-farm payrolls might drive this up today, which means you'll just take it down next week or later today. Because you're like, all right, well, whatever, overreaction. Okay? So I want you to not just react to the news, but think about where we'll be even just a month. Okay? So for example, this move here that's already happening, I already talked about that 24 hours ago. So those people that have traded there, that was a plan a day or two ago. You could have set that up 48 hours ago. So now if non-farm payrolls pops this up, they'll take it down. Now we don't know how far it'll pop up, but somebody is doing a very logical trade here and their target is down here. So even if it goes up a little higher, they'll try again next week. They're not going to chase because they've already made the decision. That's logical. So what happens over the next 1 or 2 4-hour candles? On the long run, probably irrelevant unless non-farm payrolls is so unbelievably surprising that everyone has to change their model. But everyone being surprised would be very surprising. Not likely. Improbable. Because most people are looking at economic data to make that decision. Okay? So again, thank you to FX Street for hosting me. This is the 194th month that I've done this webinar. Okay? If you like my style of training, maybe visit FXBootcamp.com. There's 65 hours of hardcore training, and it's a whopping $88. It's stupid cheap. So if you want to learn things like macroeconomics, fundamental analysis, technical analysis, trader psychology, all of that is there. Okay? For a whopping $88. And I invite you to visit tradersway.com if you want a trustworthy, ethical broker. So we're going to do a high volatility event-driven strategy today, but I think you should be more focused on the counter trend trades, which means the lowest low, if it's counter to what you believe is likely to happen on the longer term, will create a bottom, and a higher high, right, may be short-lived. Okay? Now, I wrote an entire article many years ago that already told you how to be trading this, so I'm assuming you've already prepared. I believe it's on the registration page too, on how to create a model for non-farm payrolls and how to trade them, both high volatility event-driven strategy and the counter trend trade. Thank you, Arve. 390, huh? Seems about right. Seems about right. I'm going to change this template here. I'm going to go with daily confluence bearish. The reason for that is X minus M. So if not today, maybe later. Okay. I'm going to mark this as a key price. Oops. Oh, sorry. I'm going to get rid of that. I'm going to mark this as a key price today. And obviously this is already in play. So it'll be interesting to see what happens next. Will it do this and then down? Will it do this and then down? Or instead, will it do this down, and then up. Okay. On the downside, the levels to pay attention to is this one is sort of like, it's there. People see it. Sort of this area here is much more important. Yeah, J-Man, we can do that. Let me finish the thought here. Okay. So, one of the things I teach is swing trading. Okay. Okay. One of the things I teach is swing trading. So if you're a swing trader and you're bearish on this, remember, your indicators don't tell you to be bullish or bearish. A strategy like swing trading doesn't tell you to be bullish or bearish. You need to make that decision. Okay? The rest is easy, so to speak, because once you know what your bias is, you're spending most of your time canceling or ignoring false positives, and you're waiting for better setups in your direction. So anyways, let me get to the point here. If you are a swing trader and you're a bear on this pair, you don't like euro, or you believe the dollar, right, the terminal rate at the Fed is higher than what's priced in today, then your plan for the month of June is sell here. By the way, I covered this over a week ago. Like, you should already know this. You should already be in the trade. This has nothing to do with non-farm payrolls, really. Okay? And your target is down here. And you've known this for weeks. So your trade plan, based on the trend of economic reports, you think this is in play. And that's what you're doing the entire month of June. Okay? So let's equate this now to technical analysis. If that's what you believe is happening, then you are a bear. Bears sell tops. Okay? And bears sell lower highs. Okay? And nothing else. I want you to think about how I'm simplifying everything. If you made a decision on the first one, that euro dollar is going to fall in the month of June, you know the best prices to sell, and you know the likely target to take profit. You're already done. You're already done the entire month of June. You just don't know if you're going to be right. That's why God invented stop losses. But if you are a bear, you only sell, so you can't buy. So all the buying opportunities you get rid of. And then you only sell tops and lower highs. So now your job is to say, do you consider this a top? Do you consider this a double top or a lower high? Either way, if that's true, then you're in the process today, tomorrow, the next day, the day after that, and the day after that of selling lower highs, lower highs, lower highs, lower highs. And what do we call that? A trend. A bearish trend is a series of lower highs and lower lows. Lower high, lower low. Lower high, lower low. And the cool thing about that is price action works so beautifully in a situation like that. So beautifully. So beautifully. But I would argue probably 90% of the effort is just getting this together. The rest is just really simple trading. Because once you get that, there are tools that are helpful. Okay? But all you really need is now price action. Okay? And that's like, okay, what do bulls buy? Do bulls buy lower lows? No. Do bulls buy lower lows? No. Do bulls buy higher lows? Yes. Higher low predicts a higher high. So once you get a higher high, what do you do as a bull? Try to figure out technically where the next higher low will be. We call this a role reversal. Oh, there's your higher low. So you buy it. You get a new higher high. What do you do next as a bull? Try to figure out where the next higher low will be. Higher low. You get a new higher high. As a bull, you try to figure out where the next higher low will be. Okay? Oh, higher low. As a bull, you get yourself a higher high, so now you want to try to figure out where the lower low is going to be. So you buy the higher low. Now you're a bull, you got yourself a higher high. What are you trying to figure out right now? Oh my God, non-farm payrolls. No, don't worry about non-farm payrolls, son. Calm down. You're in a trend. Okay, you like Aussie dollar. Now, I would argue you could probably find a better pair, but whatever. All I know is if you are trading this, you're a bull. If you're not a bull and you're trading this, then you swing both ways like a broken gate. Anyways, if you are a bull and you have been trading this and you see this as a higher high. Now, look, I'm not looking at pivot points. I'm not looking at things that could potentially become a top. We're only looking at price action now, and price action is fairly easy. This was a top and this was a top. So if you are still a bull, see what I'm arguing is all these higher highs could be the end of the trend. Well, that's why I use pivot points. They're a leading indicator, but don't worry about that here. If you are a bull and have been a bull and are still a bull, then this is the basis of what's going to happen next. If you think it's going to fall down to here, you're not a bull. You're like, it's going to make 100% retracement. Then you've lost your bullishness. You should have taken profit if you think that way. So we just had non-farm payrolls. Aussie dollars coming down on a 4-hour chart. And you say to yourself, good. Why? Because you are a bull and bulls buy low. And it's falling, so you can get a good price. Good deal. Okay. Now, you might ask yourself, well, Wayne, what if it comes all the way back to here? Well, then your uptrend is vulnerable. And very often when you get 100% retracement, and by that I mean measuring from this low to this high, and you're already back into this low, then I would take this zone that I just marked out as a potential buy, which you never would have gotten an opportunity if it fell all the way down here. Then it sets up the potential for a head and shoulders reversal pattern. Okay. And we all know what that means, right? Could be the end of a trend. And bears take over because they sell lower highs. Okay. I would argue in this case right here, there is no bears selling this. It's still bullish. There are no bears selling this. None. And you're like, but Wayne, look at non-farm payrolls, blah, 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 blah. Whatever. So what's going on then? Why the big red candle? Non-farm payrolls scared bulls out of their positions, and they have taken profit. They're like, give me my money back. But why are there no bears on this? Bears sell tops. By the way, I don't consider a higher high a top. I consider instead a double top or a triple top. That would be a top. Because basically they're ranges that collapse. So double top, triple top, fine. Quadruple top is just big, long range and eventually it breaks up. Fine. Bears sell tops. Then you're like, well, Wayne, is a head and shoulders pattern, is that a top? No. No, it's not. Okay. So again, to highlight this, okay, that, right, looks like a head and shoulders to you, right? Yeah, well, it's just a fancy way of saying lower high. That's all it is. I don't care if you want to call that a head and shoulders, crown pattern, range bound, blah, blah, blah. There's 15 names for the same thing. By the way, if you got 15 names for the same thing, you're not that smart. You're trying to be smart, and smart people don't have to try. Right? You don't have to try to be smart if you're smart. So you call it as it is, and you're like, that's just a lower high, bro. That's all I care about. Okay? 100% retracement, lower high, sell it. Lower high, sell it. Done. Okay? And bears sell lower highs. Bears do not sell higher highs. That is not a good entry for a bear. This is a good entry, and this is a good entry. And so that's why I look at this like, you'd have to be a fool to sell this as a bear. Bears only sell lower highs, so you got to wait for that. And then you're like, well, then who's selling it? Nobody's, well, actually, there are sellers here. Who are sellers? Bulls are selling. Okay? They are manually taking profit, or their stop losses are being hit as this candle goes red, 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 triggering more stops, triggering more stops, triggering more stops. Well, if this is an uptrend, then the stops are sell orders. You see? They're long. They're in the market bullishly. They bought. However, their stops are sell orders. They're getting stopped out. Bulls are the ones selling. Bulls are selling. It doesn't become a bearish market until bears are selling. So, long story short, what might be the trade of the day? We don't know. I'm not making a prediction. I'm not sending out a signal. What I'm saying is, if you are still bullish, you have a rationale for bullishness, and you buy higher lows after higher highs, then you're going to plan for something like this today. Higher high, higher low. That's a buy. 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 Higher high. And now you're freaking out? The sky is falling. The sky is falling. So if you're freaking out, that means you probably missed this, you probably missed this, you probably missed this, you probably missed this. And once, and you're also freaking out about this red candle, so you're likely to miss this. And then you're going to counter all that because you're going to get emotional about it. Oh, Wayne, you're hurting my feelings. You're hurting my ego. Okay. So you say, well, Wayne, how do you know it's not going to fall here or here or here? I don't. You don't. But you're emotional about it. Okay? So if you do buy it up here, use a stop loss. Okay? And they're like, but Wayne, where do I put my stop loss? Below support. Why is this confusing? If you're a buyer, put your stop below support. Then you're like, but Wayne, that's so far away. I can't afford to stop that far away. Cut your lot size. It's not confusing. If you can't afford to place your stop in the right place, you're over leveraged. You're a degenerate gambler. So lower your lot size. Be a professional, for crying out loud. Okay? Jove says, hey man, link to the bootcamp. FXBootcamp.com. I think I can type it in now, right? It's a whole whopping $88 though, Jove. So anyways, the way I trade, and you see some examples in here, but WWWD, what would Wayne do? Okay. I would connect this, and that's how I would look at it. Another way, if you don't like that process, that's price action, by the way. We call that a role reversal. What used to be resistance becomes support. The other way to do it is use your Leonardo Fibonacci. So let me change the template so it's easier to see. Okay. Be a simple kind of trader. Okay. You do something like that. And then you say, somewhere in here, you'd like to buy. Another way of doing it is this. Okay, there's so many ways to do the same thing. That's why don't get caught on some guru and using some, particular types of setups and proprietary indicators and all. Don't. My moving averages are the only ones that work. No, gee whiz. There are so many different ways to do the same thing. Like, it's not a problem. Okay? So what you might want to say is buy pullbacks to the 21, buy pullbacks to the 21, buy pullbacks to the 21, buy pullbacks to the 21. Look, buy a pullback to the 21. And you're like, but Wayne, what if this hits and falls? Yeah, you'll take a small loss. Get over it. If you can't afford a small loss, then you're over leveraged. Cut your lot size. Huh? How's that about raw honesty? Okay. Well, at the beginning of the webinar, I already covered pound and I already covered yen. I'm not going to tell you whether you should be buying or selling. So buy positions. I don't know. What do you want to do? Okay. But we can look at things, but I'm trying to show you how to trade. Yes, we're looking at euro dollar. I don't care about euro dollar. I'm trying to show you how to make decisions so you can pull up the pound yen and do the same thing here. Think about these questions. Is it trending up? Up, down, or sideways? Okay. Another thing, by the way, so we'll just leave it here. All of this is obvious. Role reversal, Fibonacci, moving average to make a decision. And then if it falls, you'll lose a little bit of money. But if you're leveraged properly, your risk is so low per trade that it doesn't even matter. I'd rather you just get in the stupid trade. Okay. Let me zip over and answer the next question here about, I'm going to pick on yen here. I'm going to pick on yen if I can get a new window. Okay. I want to show you the 10-year yield. Okay. Okay. Do you see anything interesting here? This is the yield on the 10-year Japanese government bond. It is currently, right this second, 0.253. Who cares? Does anyone want to take a lead on this? How many people here have I taught the importance of the 10-year JGB? How many people here have I taught the importance of the 10-year Japanese government bond? Give me your yip. What's up? Aye. Jim? Johnny? Anybody else? Jim and Johnny? Andrew? Dan the man? Dan, you should know, Dan. Dan, you should know. Man, we got to fix that, Danny boy. Andrew, yeah, Peter, JGB. Okay. Aye, look at everybody. Yeah. Yeah, well, that's fine. It's fine. We gotta fix that is all I'm saying. Yeah, Constantine, right, cool. Now, let me ask you, so the current yield is 0.253. Let me put that back. Does it matter? Like, how do you look at this? Are you going, that was supposed my mouse is so bad here. These are supposed to be straight lines. Is this like, oh my God, shields up, red alert? Or is it sort of like, huh? Okay. If you think this is red alert, type in red alert. And if I've taught you that this number is sort of irrelevant, it's not really here nor there. Okay. Andrew says red flag. No, Jim, I have it as 2.53 is what I have, not 2.35. Yeah, Jim's like, whoa. I mean, think about that. Think about what Jim just said. Wait, it's 2.35, right? Because it has been for a few days. And then he's like, what? Wait, it's 2.53. Oh my God. That's red alert. Now, my point here is, I would guess 95 to maybe even 99% of retail traders don't track this, don't care about it, don't know about it, have no clue, know nothing. Okay? So imagine if you're one of those guys, you're like, I have no idea why a currency trader would track the yield on the 10-year Japanese government bond. And yet other people think it's red alert. Well, in Japan, the Bank of Japan has something they call yield curve control based on qualitative and quantitative analysis, or easing, sorry, qualitative and quantitative easing. That there's the program, and it's a radical program. See, the Bank of Japan invented quantitative easing. They invented negative interest rates, and they've now invented yield curve control. And did you know they actually tell you the day that they are interested in buying Japanese government bonds to manage their yield curve control policy? They have an unlimited budget, and they even tell you which bonds they're going to buy. They tell you, they post it on the website. And this has a direct impact in the value of the Japanese yen. And yet you might be trading the Japanese yen and you have no clue as to why it's moving. Because you, as Michael Jackson might say, you ignorant, you just ignorant. Don't get upset at me, I'm just having fun. But anyways, that's what Michael Jackson would say, right? You just ignorant. All right? There are reasons and rationale, and the world tells us, the Bank of Japan will tell you, or actually tells you, they publish it. And what they're telling you is there's something about to happen. And it happened here, it happened here, and it happened here. Whoa, dude. And so there's two things. This might happen. They drive the yield down. But even more importantly, what if that doesn't happen and it goes here and they change it from 0.25 to 0.28, and then eventually they're going to change it to 0.33, and I've already taught people this at FX Bootcamp. But the thing is, what matters now is that this is being tested. And it was tested here, fell, tested here, fell, tested here, fell, so on and so forth. So now I'm going to leave it to you because I actually have to go today. I have to go. I'm really sorry. Something came up today. I got total, absolute chaos going on, and I have to be in I have to be in 3 different places at the same time, and I'm going to disappoint everybody. So my apologies to FX Street and our moderator, but I do have to go. But I want to leave this challenge with you because something important might about to happen now. The yield on the 10-year Japanese government bond is up 5.5% right now. This little spike here could be radically important. So I want you to go back in time and say, well, what happened when we hit 0.25? What happened here? What happened? Like when it went from 0.25 all the way down, what happened to the value of the Japanese yen? And then it kind of fizzled, came back up. We hit it again. Boom, dropped. Well, what happened to, I don't know, dollar yen, Aussie yen, whatever you want yen? What happened when we hit it a third time? And what might happen now if it repeats? Another thing you might want to look at is what happened. Well, this is actually quite normal, and this is actually not that normal. So go back and say, well, because this will be easy. In the beginning of March, okay, well, in the middle of February, let's say, there was a big down. What happened to the value of the Japanese yen during the big down? Then at the beginning of March, there was a big up in yields. What happened to the value of the Japanese yen? And then this stuff happened. So what happened? So I would look at Feb and say yields were down in Feb. What happened to the value of the yen? Then March was a crazy up month in as far as yields on the JGB. What happened to the Japanese yen? And then it's consolidated. Why? Because we were told that that would happen. You should not be shocked even in the slightest. There were press releases, for crying out loud. You can just read it. Like, if you don't know this, like, why don't you know this? It's been published. It's like obvious. You must know this. And then, of course, go back and do a little bit of technical analysis and say, well, fundamentally, this is the pattern that's occurring and being addressed by the bank, the Central Bank of Japan. And you should go back and say, well, what happens when this goes up? What happens to the yen? When this comes down, what happens to the yen? When this goes up, what happens to the yen? When this goes down, what happens to the yen? Because then once you figure out the up and down of yields relative to price, then if this goes up higher, you already know what's going to happen. And now you have a fundamental basis for your technical bias, and now you're setting up trades properly. And if this comes back around, you totally get it. You know why. And you're like, I know how to trade this. And you know why before you even open up your chart. And that's what I hope to inspire you to do. Look before you leap. Okay? Understand before you trade. When you have intent and you open your charts with intent, you will not be fooled by short-term volatility. I want you to ask yourself, are you a volatility trader or a trend trader? I want you to live that out. Volatility is just news came out and something happened and I got a red candle, so I guess I shorted. That's a vol trader. But a trend trader will say, well, there's a rationale behind why things are happening. And I don't mean all fundamentals. You're like, Wayne, I love technicals. I love technicals. But what I want you to have, maybe not this year, maybe not next year, but throughout your career, I want you to have a healthy understanding of both technical and fundamental analysis so you can make decisions. You don't rely on alert services and signal services. You don't listen to people on TV except to compare what they're saying with your own research and knowledge and opinion. Okay? Anurag says, I'm completely a technical trader and live with the trend. I also live with the trend. But my challenge to you, because I'm not saying technicals are bad, I'm saying technicals are good. What I'm challenging you is to be a master of your domain. I want you to be an expert when it comes to foreign currencies. Think about it. The conversations around your trading history when you're meeting with a potential investor, pretty straightforward. Okay? Percentage return. Okay? Over long periods of time, sharp ratios. Those conversations are usually fairly quick. Because you're going to say, this is what I did as a technical trader. And people are like, oh, well, your sharp ratio says you're, adequate. And then you look at it, and because it's adequate, you probably don't have huge drawdowns and all that kind of stuff. So you're like, okay, all right, good. You produce, you produce enough returns for me to be interested. So those conversations are usually quite short. Okay? You're good enough. That's why you have a meeting. But when you sit down and you do a presentation, even when you do the presentation, I don't think that's when you win a client. Usually you're sitting you're having steak dinner, you're drinking wine, you're smoking a cigar, and they say to you, Anurag, what do you think about oil? And you can talk about it, right, in great detail and show a fundamental rationale and reasoning for your bias on oil. They're like, because when they say, what do you think about oil? What they're asking you is, do you think it's going to go up or down and why? If your answer is, I don't know, I trade price actions, or I don't know, it depends on what my MACD says. I won't know until blah, 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 blah. It just does not win a client over if you say, I have no idea what's going to happen in 2 weeks. I can't even fathom what? I just show up and I'm pure technical and it just shows me like right now there's a trend, so I'll just keep buying dips. Okay, that's enough as a trader. We know that's usually enough. But if you're going to like start a fund and raise money, they're going to ask you, hey, what do you think about the dollar? What do you think about gold? What do you think about Bitcoin? Right? And you can't be like a Cardi B and say, it's up and then it's stuck, right? It's more like, well, let's break it down. Let's break this down. Let's talk about oil. Let's look at the recent EIA, Energy Information Agency, which is a government agency in the United States. And one of the things that they show you is oil inventories in the United States right now. But if you go back and look at the 5 years 5-year average of oil inventories in the United States, and then look at the standard deviation above and below that 5-year average, you'll see that we're currently at 400,000 barrels and drawing it down at 5%. And if you extrapolate that out into the opinion about what oil and gasoline are going to do over the next 6 months. And it should be enough to say, oh my God, you know instantly? You know how many barrels of oil are in storage right now? Yeah. You know the 5-year average and the standard deviation around the average? Yes. You know the current drawdowns of oil and oil inventory in the United States? Yes. Do you know that we're 14% below needed levels of oil in the United States? Yes, I do know that. Yes, I do. I know that we're 14% below. And therefore, you have an opinion because you're taking that current level, the 5-year norm, and the seasonality, and you can extrapolate that out into an opinion on oil prices going 3, 4, 5, 6 months in advance? Yeah, I can. Huh? And that's where I'm trying to get you. Okay? I'm trying to get you to that level. And maybe it's only useful to you to have a conversation with a potential investor, and the rest you're just going to do technical analysis anyways. Well, at least you have a healthy balance of both fundamental and technical analysis. My pitch to you is to have a healthy understanding of both technical and fundamental analysis, because I think it will help you succeed as a trader. You know why you're doing it, and I think that's important. Cool. So thank you to FX Street for hosting for the 194th month. I apologize for it being short, but I got cranes, I got tractors. There's more than a dozen men on my property right now. There's trucks everywhere, just tractors, just total chaos going on. But I'm being productive, and I'm trying to make America a better place by keeping everybody employed. And I've been doing that for a while. So anyways, so thank you to moderator for moderating like no other moderators ever moderated before. There's nothing moderate about our moderator. We have an extreme moderator. Thank you. So peace on earth. May the pips be with you. May your profits be above average. Please visit tradersway.com. Open up an account with a trustworthy, ethical foreign exchange broker. I believe you will like them. Give them an opportunity to earn your loyalty and respect. And if you like the technicals and the fundamentals that I covered today, I just scratched the surface. There's 65 hours of hardcore training videos at FXBootcamp.com. And the price is, wait for it, $88. Stupid cheap. So if you like some of the stuff I'm talking about, dude, get going. You can start right now. Start the videos right now. You'll love them. I'm telling you, you'll be impressed. A wonderful weekend. I'll see you when I see you. Cheers.